Most traders think bigger positions equal bigger profits. They are wrong. And by the end of this video, you will understand exactly why the traders making the most consistent money in the markets are the ones risking the least. Stay with me, because what I'm about to share goes against almost everything the trading influencers world wants you to believe. Let's start with a question. Why do most retail traders blow up their accounts within the first year? Is it because they didn't find the right strategy? Is it because the market is rigged against them? Or is it because they simply don't understand what risk actually costs them? The answer is the third one. And it all comes back to position size. When a new trader opens a $5,000 account and immediately risks $500 on a single trade, that's 10% of their capital gone in one move. And here's the thing about losses, they are not symmetrical. If you lose 10%, you need an 11% gain just to get back to where you started. Lose 20%, you need 25%. Lose 50%, you need a 100% return just to break even. The math is brutal. And it is working against every trader whose size is too big. But the traders whose size small? They live to trade another day. They protect their edge. And over time, compound it. Let me paint you two pictures. Picture 1, a trader with a $10,000 account who risks 5% per trade. That's $500 per trade. After a string of 5 losing trades in a row, which happens even to the best traders in the world, they've lost $2,500. Their account is now at $7,500. They are shaken. They are second-guessing their strategy. Some of them will double their position size trying to make it back fast. That is where accounts go to die. Now picture 2, a trader with the same $10,000 account who risks only 1% per trade. That is $100 per trade. After 5 consecutive losses, they've lost $500. Their account sits at $9,500. They are calm. They are clear-headed. They stick to their system. And they keep executing. Same strategy. Same market. Same losing streak. Completely different psychological and financial outcome. That is the power of trading small. Now here is where it gets really interesting, and this is the part most traders never hear about. Trading small doesn't just protect you from losses. It actually increases your profitability over time. And the reason comes down to 3 things: consistency, compounding, and psychology. Let's break each one down. Consistency. When you risk too much on a single trade, your performance becomes erratic. You win big, you lose big. Your equity curve looks like a roller coaster. And a roller coaster equity curve is a sign of a gambler, not a trader. But when you risk small and consistently, your equity curve smooths out. It starts to trend upward in a steady, reliable arc. And that smooth curve is what institutional traders and professional fund managers are obsessed with. It's called the Sharpe ratio, a measure of return relative to risk. The higher it is, the better your risk-adjusted performance. You don't build a high Sharpe ratio by swinging big. You build it by trading consistently small. Compounding. Albert Einstein reportedly called compound interest the 8th wonder of the world. Whether he actually said that or not, the math speaks for itself. Let's say you make an average of 2% per month on your trading account, net, after losses. That is not a fantasy number. Many disciplined traders achieve this. Now watch what happens over time. Start with $10,000. After 1 year of 2% monthly growth, you have approximately $26,000. After 2 years, over $67,000. After 5 years, over $787,000. From a $10,000 starting account. Without adding a single extra dollar. But here is the catch. Compounding only works if you don't blow up. And you only avoid blowing up if you trade small. Every time you risk too much and take a massive loss, you reset the compound clock. You wipe out months of gains in a single trade. Small position sizing is what keeps the compounding engine running. Psychology. This is the one nobody wants to talk about. But it is arguably the most important factor in trading success. When you risk too much money on a single trade, something happens in your brain. The emotional stakes become so high that rational decision-making becomes nearly impossible. You start micromanaging the trade. You move your stop-loss. You take profits too early out of fear. Or you hold on too long hoping it comes back. This is not a discipline problem. This is neuroscience. When real money is on the line, the brain's amygdala, the fear center, hijacks rational thought. It is a survival mechanism. And it is the enemy of good trading. But when you risk only 1% of your account, suddenly you are calm. You place the trade, you set your stop, and you walk away. You let the trade breathe. You follow your rules. Because losing $100 on a $10,000 account feels manageable. It doesn't trigger the panic response. And a calm trader is a profitable trader. Let me give you a real-world analogy. Think about a casino. The house doesn't win because it makes massive bets on single hands of blackjack. The house wins because it has a small statistical edge, just a few percent, and it applies that edge consistently, thousands of times per day, across hundreds of tables. The house never bets the whole floor on one hand. It keeps its risk controlled. It lets the math work. And over time, the math always delivers. That is exactly how professional traders think. They are not looking for the one trade that makes them rich. They are looking for a repeatable edge, and they apply that edge with disciplined, small position sizing, over and over and over again. The profits are inevitable. Now let's get practical. How small should you actually be trading? The general rule used by professional traders and risk managers is the 1% rule. Never risk more than 1% of your total trading capital on a single trade. Some of the most successful traders in the world risk as little as 0.25% to 0.5% per trade. To implement the 1% rule, here is the formula. Take your account balance. Multiply it by 0.01. That is your maximum dollar risk per trade. Then, based on where your stop loss is, calculate how many shares, contracts, or units you can buy so that if the stop is hit, you lose no more than that dollar amount. For example, $10,000 account. 1% risk equals $100. You are trading a stock at $50, and your stop loss is $2 below your entry. $100 divided by $2 equals 50 shares. That is your position size. Simple. Mechanical. Repeatable. Here is another concept that trading small unlocks, and this one is a game changer. When you risk less per trade, you can take more trades. And when you can take more trades, you give your edge more opportunities to play out. Think about it this way. Your trading strategy has a win rate of 55%. That means over a large sample size, you win slightly more than you lose. But in any given streak of 10 or 20 trades, you might hit a losing run. If you are sizing too big, that losing run wipes you out before your edge has a chance to assert itself. But if you are sizing small, you can weather that losing run. You stay in the game. You get to trade 50, 100, 200 times. And at 200 trades with a 55% win rate, the math becomes powerful. The law of large numbers is on your side. Small position sizing is what gives your edge time to work. Let's address the number one objection people have to trading small. I don't have enough money to make it worth it. This is one of the most common and most dangerous thoughts in trading. And it leads traders to either over-leverage their accounts or give up entirely. Here is the truth. If you are trading to make rent money, you are already in trouble. Trading is not a get-rich-quick vehicle. It is a skill, one of the most demanding skills in the world. And like any skill, you need time to develop it without catastrophic consequences. Trading small gives you that time. It is your tuitions. Every small loss is a lesson that costs you almost nothing. Every small win builds your confidence and your account. Over months and years, you develop the skill, the system, and the track record. And then, with a proven edge, you can responsibly scale up. But the traders who try to skip that process, who jump straight to big positions to make big money fast, almost always end up losing everything. The irony is brutal. The fastest path to trading big profitably is to start by trading small. There is a concept in trading called risk of ruin. It refers to the probability that your account goes to zero given your position sizing and win rate. And what the math shows is absolutely sobering. Trader with a 50% win rate and a 1-to-1 risk-reward ratio who risks 10% per trade has an extremely high probability of eventually going bust, even if their strategy theoretically breaks even. Why? Because variance. Because losing streaks. Because the randomness of markets in the short term. But that exact same trader, with that exact same strategy, risking only 1% per trade? Their probability of ruin drops to near zero. The strategy didn't change. The market didn't change. Only the position size changed. And that one change is the difference between blowing up and building wealth. Let me share something that professional traders call the paradox of position sizing. The more you want to make, the less you should risk. Because the traders desperate to make huge returns take huge risks. And huge risks lead to huge drawdowns. And huge drawdowns force emotional decisions. And emotional decisions destroy accounts. Meanwhile, the trader who accepts small controlled returns, who is perfectly happy making 1% to 3% per month, builds steadily. They are not stressed. They are not emotional. They are not revenge trading after a loss. They execute their system with military precision. And their account grows like a slow, unstoppable tide. In 5 years, the aggressive trader has likely blown up 2 or 3 accounts and is starting over. The disciplined small trader has turned $10,000 into a 6-figure account. No drama. No blow up, just steady, consistent growth. One more concept before we wrap up, and this one is about leverage. If you are trading forex, futures, or CFDs, you have access to leverage. This means you can control a position much larger than your actual capital. And this is where trading small becomes even more critical. Leverage amplifies both gains and losses. A 10-to-1 leveraged position means a 5% move against you wipes out 50% of your capital. Many brokers offer 50-to-1, 100-to-1, even higher leverage. In the wrong hands, this is not a tool. It is a weapon pointed at your own account. The professional approach to leverage is to use it sparingly, if at all, and to size positions as if you have no leverage. Let the leverage simply allow you to participate in markets that would otherwise require larger capital. Never use it to inflate your position size beyond what your risk management allows. The traders who blow up on leveraged accounts almost always have one thing in common: they size too big. So let's bring this all together. Why is trading small more profitable than trading big? Because it keeps you in the game long enough for your edge to work. Because it removes the emotional interference that destroys rational decision-making. Because it allows compounding to work in your favor without interruption. Because it reduces your risk of ruin to near zero. Because it builds a smooth, consistent equity curve. Because it gives you the psychological clarity to execute your system with discipline. Trading is not about the size of your bets. It is about the quality of your decisions, made consistently, over time, with controlled risk. The best traders in the world are not the ones taking the biggest risks. They are the ones taking the smartest risks. And smart risk always means small risk. If you are watching this and you are still risking 5%, 10%, or more per trade, I want you to do one thing tomorrow. Just one. Open your trading platform and cut your position size in half. Not forever. Just for the next 30 trades. See what happens to your emotions. See what happens to your decision-making. See what happens to your equity curve. I promise you, it will feel almost boring. And boring in trading is exactly what you want. Because boring means consistent. Consistent means compounding. And compounding means wealth. If this video gave you a new perspective on how to approach your trading, do me a favor, hit the like button. It helps this channel reach more traders who need to hear this. And if you want to go deeper on position sizing, risk management, and building a trading system that actually lasts, subscribe. There is a lot more coming. See you in the next one.